One of the most highly debated topics when it comes to real estate investing is what is better, cash flow or appreciation? In this video, I ran the numbers, I did the math, and I want to show you what I think is the better play if you are a real estate investor. So I'm going to walk you through two different properties, two different strategies, and the results that end up after a 15-year period and a 30-year period. Now, of course, I picked numbers that I thought were pretty realistic. But of course, these numbers can vary slightly, and you can, of course, tweak the numbers to see what works best for you. But okay, so here is investment number one. So you can buy a cash flowing deal that costs $130,000. That's the purchase price of the property. Your out of pocket cost is $20,000. Your monthly profit is $1,500 per month, and your annual appreciation is 0.05%. Okay. So let me break this down a little bit more. This is the type of deal that I'm personally buying right now. And you might be thinking, Bailey, how are you only doing $20,000 out of pocket? Well, I'm doing the Burr strategy. So my goal is really to have less than this out of pocket, but I wanted to be conservative and say $20,000 in case, the construction runs over, which it has before. And of course, I also have to furnish these properties because I'm doing a midterm rental strategy. But because I'm doing the midterm strategy, my monthly cash flow, my monthly profit is a lot higher than a traditional rental, which is great for me. But I do know that the annual appreciation is next to nothing on these. So this is one scenario where, hey, you're just going for the cash flow. And then here's investment number two. So a different type of investment you can make with a similar amount of money, but a little bit more, is you can go for the appreciation play. Now, a purchase price on something like this, again, as an example, $450,000. Your out-of-pocket cost, I'm saying $50,000 here, because again, I'm assuming you're using the Burr strategy. I'm trying to give as much comparison and leniency both ways. And your monthly profit at the end of the month is break even. Okay. Now, why did I pick $0 or break even for this? Because for a $450,000 property, even if you're running it as a short-term rental or a mid-term rental, you're going to make some cash flow off of it. There's no doubt. And if you do it right, you can make cash flow 100%. But at the end of the day, a $450,000 property is going to be a lot more money to actually run. This might be a bigger property that has a bigger roof, multiple HVAC units. So even though you are making money with it, if you have a big expense, it's pretty much going to wipe out the cash flow. Whereas in this deal, number one, my gross revenue from this is about $3,000 to $4,000 per month, and my mortgage is only $500 to $1,000 a month. So those expenses are already really factored in to this monthly profit number. Whereas the appreciation play, again, bigger, more expensive. You're not going to be making a ton of profit. So just want to put that out there. But the annual appreciation, on average, I put 2%. Obviously, it's going to appreciate more than a cash flow market. And some years it might be a 5% appreciation. Some years might be zero. Some years might be negative. But overall, over a 15, 30-year span, 2 to 3% is what you'd expect. Okay, so side-by-side comparison. Investment one, we just talked about that, $130,000 purchase price, $20,000 out of pocket, monthly profit of $1,500 with very little appreciation. Investment two, $450,000 purchase price, $50,000 out of pocket, monthly profit $0, and your annual appreciation is 2%. So how does this come out after 15 years? So after 15 years of holding the property and running the strategy, investment number one is going to profit a total of $270,000 in that 15-year span. The appreciation gain is, again, next to nothing. It's less than $1,000. The total return from this is $270,000. So your ROI after 15 years is 1,355%. Okay, compared to investment number two, again, profit close to zero, right? Maybe $10,000, maybe $20,000, whatever. But the appreciation gain is $155,000, which is technically 311%. But the only thing is you can't actually touch that money. That's just appreciation and equity gain in the property, but you can't actually touch it. So it's really unrealized gain. So that's just after 15 years. Now, if you go down to the 30-year outcome, the cash flow from the first investment is going to be a $541,000 return. Again, very little appreciation. but that's a 2,710% return. Whereas investment number two, again, profit close to zero, is going to be, again, if you don't sell the property, it's a $0 gain. If you do sell the property, it'll be more like an $815,000 asset value. And again, that's because your purchase price was $450. With the appreciation, it went up $365,000, which brings you to this $815,000 number, which is a 1,530% return, which is a lot less than investment number one, where it's the heavy cash flow deal. But wait, there's more. So I talked to ChatGPT and I said, okay, given the information below, which is what we just talked about, what if I built up a cash reserve for the first investment strategy where I did the cash flow strategy? And once that cash reserve hit $60,000, I would then deploy $30,000 to buy a house that would then cash flow $1,500 per month, and kept repeating this as many times as you possibly can, given the buildup of that pretty large reserve. So when I asked it that, here is what it came back with. So year one, the annual cash flow was $18,000, but I couldn't buy a new property because my cash reserve wasn't enough. Same thing for year two. But then year three, I did have enough money in the cash reserve to buy a new property. So now the annual cash flow just doubled to $36,000 a year. I had to wait another year, but then I had enough money after 2 more years to buy another property. So now my cash flow is up to $54,000 per year. And it kept on going for 10 years, so on and so forth. And after 30 years, it says I can have 20 properties generating $30,000 per month in cash flow, which is $360,000 per year. So $5 million in cash flow received over 30 years, $2.4 million in equity. And that is just from one investment on the front end. And just from reinvesting the cash flow from that one investment. Now imagine if you have one investment property and you take all the cash flow from that, you keep on doing it, and then you bought a second investment property, and then you kept on buying more and more and more. This is the beauty of compounding, and why I think right now cash flow is a better metric than appreciation. I'm really curious to hear what you guys think about this in the comments below. Let me know your thoughts. I'm open to it, and I'll see you guys in the next video. Peace.